Are you tired of getting caught in false breakouts or missing the real opportunities? Trading breakouts doesn't have to be a guessing game. In this video, I'll show you how to read price action like a pro, dissect it step by step, focusing on the critical pre-breakout phase. You'll learn how to spot reliable breakout signals, avoid common traps, and align your trades with the market momentum. If you've struggled with breakouts before, this guide will transform the way you trade. Let's get started. To trade breakouts successfully, you need to master the pre-breakout phase. This is where the groundwork for a solid move is laid. And some of the things to actually look out for include: 1. Look out for a clearly defined range. You want to see several candles forming obvious support and resistance levels. You want the breakout level to ideally be horizontal. You want to see at least 2 touches on both sides. Remember, the market is a battlefield, and every day new opportunities always arise. This tells you that at any time you open your charts, there's a tug of war that is ongoing. This tells you where the market order flow is concentrated and where stop loss is actually likely to be stacked. More is better. You want to see more touches. Ideally, more than 2 is actually better, but at a minimum is 2. And the stronger a level is defended before it yields, the more dominance is displayed by the ultimate victors. The second thing you need to look out for, which is actually a major clue, is shrinking rejections. As price gets closer to a level, you'll notice rejections becoming smaller, creating patterns like wedges. You'll see descending triangles, you see ascending triangles. This is what leads to a scenario where you have higher lows or lower highs to a level. These are actually signs that the tug of war is resolving. Why? The higher lows indicate that buyers are gaining control and the market is about to continue bullishly or turn and become bullish. Lower lows suggest that sellers are taking over in a bearish setup. In a bullish scenario, bulls always defend their positions by buying higher. You'll tend to see pin bars and higher lows too, a level that is about to be broken. The bearish scenario is basically the opposite of that, yeah? And the last thing you want to be caught out is being in the opposite side of the trend, yeah? If it's in a bullish breakout scenario, ideally you want to be with the bulls. You don't want to be with the bears, yeah? Why? Will be bears that will join you in that trade are only bailing out. They're throwing in the towel. Those who are already in the market are taking their profits. They're closing their positions. That's why you see in a scenario where market is now forming higher lows. Anyone who will be a will-be bear is actually leaving the market. You don't want to be jumping into the market at this time, yeah? After everyone has jumped out, basically, assuming it's a bullish setup, the bears have jumped out, you will see the market building a pre-breakout tension, yeah? So this is the next thing to actually watch out for. Watch out for building tension. Think of market like a spring, yeah? This tension is like a range and it's like a spring, yeah? And typically ranges will be directionless, but over time, the pressure builds up and you'll see, because of patterns like your higher lows or higher highs, depending on the pre-breakout direction, at some point, new participants, ideally both short-term traders, medium-term traders, and long-term investors, start accumulating positions in anticipation of the breakout. This is why you tend to see accumulations before the final breakout actually happens, yeah? Another important signal to actually look at is the relationship of the EMA with the candles that are on the chart. Before the breakout actually happens, during a squeeze, you'll find the squeeze actually happening just within the EMA. Assuming we're breaking out to the upside, you'll tend to see candles respecting the EMA. Price might poke through. You might see wicks actually breach the EMA, but most of the candle bodies will actually be within the EMA. This is what I actually call an EMA carry. You'll see it basically shows momentum is building for a breakout, yeah? After the breakout happens, ideally you want a scenario where majority of the breakout candle is above the level. Assuming you're broken to the upside, you want your bullish candle, its range, more than 50% of that body range to be above the level. If it's a breakout to the downside, you want more than 50% of that candle range to be below the level. And finally, most importantly, the breakout is more reliable if it aligns with the dominant order flow or the overall trend. Going against the prevailing momentum just increases the risk of a false breakout, which is a situation you don't want to be caught out in. The outliers where you can actually trade breakout that is counter trend, and we'll be looking at that when we get into the examples, yeah? Let's deep dive into the examples. The first example is a gold chart. This is a daily chart. I have this structure outlined here. As you can see, there is a clearly defined level, which is a resistance. Price hit that level. First time here, sold. This is close to the 2480 region. Look at the second touch. Look at the reducing rejections. Look at how far the first rejection went. Look at how far the second rejection went. And finally, the third touch, which is actually the final touch before the breakout. Look at how far it went. So you're seeing reducing rejections, which is causing a scenario where the market is forming higher lows, leading into this ascending triangle pattern. And finally, we did see the breakout. If you look at the breakout candle over here, majority of this candle range is actually, let me say, around 50%. Yeah, close to 50, which is our threshold. 50% of this body range is above the level. Yeah, and prior to the breakout, you can see the behavior of the EMA. Look at how price was behaving with how price was interacting with the EMA previously before the breakout. Look at how it was piercing the EMA, but just prior to the breakout, you can see it's like a squeeze. Yeah, the EMA is carrying price and it squeezes until it breaks out. Yeah, this is in as much as it looks like a swing point, given it's a daily, it's more of a squeeze also. You can see the candles. Look at the candle ranges, quite small, and look at how far the swing went. The EMA squeezed it, act like a final form of let me call it support here. Price did not breach through, and we did see the breakout. The breakout was in line with the dominant trend. Gold has been in an uptrend for quite a while. Yeah, and you can see it worked out well. I actually took the trade when we broke here, and I managed it and trailed the stop till when the price action actually broke down, given the prevailing fundamentals. The next chart I want us to look at is the New Zealand dollar. I've spoken about this trade recently in one of my recent videos. Yeah, we did see the structure breakdown when this swing point was taken down. The market was actually establishing a downtrend, and I want you to see, yeah, this continuation pattern. This is an example of a breakdown to the downside, yeah, where we have a clearly defined level. How many touches? 1, 2, 3. It may not be perfect on the first touch, but remember, support and resistance areas actually zones, yeah, not a specific line, yeah, just zones. But I'm just using this as a reference to make the example simpler. The first touch, second touch, third touch, until finally we did breakdown. If you actually go back to if you go down to the lower time frames, you see this candle here, the green candle. This is a spinning top. If you go down maybe to the 5 minute, you find it, but this is actually a swing point, one of the last swing points before the breakdown. And I want you to see the price action that it actually meets the criteria that we've spoken about. We are seeing lower highs to the level. We are seeing reducing rejection. The bulls are being squeezed out of this market. I want you to look at this swing point. You see this swing point where we have this red candle, small green candle, and a red candle. Look at how it engulfs this entire price action before we see the breakdown. There are no bulls left in this market. Yeah, if you wanted to actually get into this market and buy around this area, and you see this as evidence, just run. Don't take that trade. Why? Will be buyers who are actually on the side monitoring the market. They won't join you. Whoever's already in the market who's long, they're throwing in the towel. They're closing their positions, taking their losses, and will be sellers who are on the side actually looking at this market. They're actually now getting into the market and piling their positions. It's already in a disadvantage if you try to buy this market at this point here. And as you can see, the EMA, look at how it carries price and squeezes it just before we get to the breakout point. 50% of this body is actually below the breakout area. And as you can see, we did get a retest, and the downtrend actually continued for a while, yeah. And you can see the breakdown was in line with the dominant order flow. You can see we had been down, retraced, a pause, a breakout, then to the downside, and a continuation of that particular price action. And now I want us to look at the Russell 2000. Same price action. This is actually a recent breakout. As you can see, we had a clearly defined level. This is an example of the market breaking out to the upside. As you can see, the rejections are getting weaker and weaker. The market chart pattern may not be perfect. Don't actually look for perfection in most of these chart patterns. Yeah, as long as it makes sense, as long as the price action makes sense, then trade it. Yeah, you can see. Look at the first rejection. Second time we go to that area, look at the weaker rejection, and the weaker rejection continues until finally we see that breakout to the upside. Price actually retested, used that breakout level as a reference point, and is actually, let me just push these, and it's actually on its way higher. The next two examples I want to take you through are, let me just use the word exceptions for now. The first one is USD Japan. This is breakout that is counter trend. Yeah, I remember one of our criteria is you want to take trades that are in line with the dominant order flow. Yeah, we did have a breakout scenario in this structure here. Yeah, although the last bit was a bit weak, there was a bit weak squeeze. Yeah, but this was a breakout scenario. It ticks most of the boxes that we spoke about. But look at the post-market reaction. It actually failed. Yeah, the market actually continued to the downside. You have a scenario where market is breaking out to the upside. You've got a new signal, but look at what happens when you take that trade. Yeah, why? Look at that. Just zoom out. Always zoom out. What has the market been doing? The market has actually been turning to the downside. Remember, whatever order flow you see on your chart, especially on the higher time frame charts, the daily, the weekly, is driven by fundamentals. Yeah, the long-term movement on your chart is driven by fundamentals and your carry trades. Yeah, at this point here, the fundamentals were shifting for the USDN. So you ideally don't want to go against that tide. So be in a habit of reading your news and just don't take breakouts that are counter to the prevailing order flow. The market was heavily bearish. You had no business actually buying. Yeah, stack the odds to your favor and only play games that strictly meet your criteria for a perfect trade. Yeah, just don't take breakouts because you've seen a breakout. Always evaluate every price action in relation to the bigger picture. So this one was an example where I'd advise you not to take. Yeah, I want us to look at another exception. This is actually the USD Swiss currency. This is an example of a breakout that was counter trend but actually worked out. Yeah, different from the USD Japan trade, and I'll explain why. Market had been going down. You can see this movement going down, but it hit a major level. Yeah, it hits a major level. Usually price moves from one key area of the chart to the next key area of the chart. If you just zoom out and look at price action keenly, you'll see the 84 handle. I'd actually marked it. Yeah, these are just wicks, so I'd put where the bodies were. You find the price was respecting the 84 handle. Yeah, so I put my support area at 84, given 84 is a big figure, and you can see previously price respected it and price was consolidating just around that level, and eventually we did have a breakout to the upside. Yeah, and I actually took this trade to the upside. So why did I take this trade? This reversal was coming after price had retested a key area. Yeah, price action is always key. Price will always move from one key area of the chart to the next key area of the chart. If you see price action like this happening around a very key area of the chart, by key area I mean a level that has been respected and has led to previously led to large moves in the market, you ideally want to take that trade. Yeah, so for this one I took because one, we did see price consolidate around the area. It didn't break to the downside, showing that price was actually respecting the 8400, and we did see a breakout to the upside. So I actually took this trade and closed majority of the position around this area when the price action was getting clear, and left something small just to ride the wave. Yeah, as you can see, price is still continue higher. Price will always move from one key area of the chart to the next key area of the chart. So I won't be surprised if price actually comes back to these highs around 92. Yeah, I won't be surprised. Yeah, but for now I'm just keeping a key eye on the current price action, which is not really nice. This is an example of a fake out where we have a swing point, price closes, but it doesn't meet the criteria that we've spoken about, and these are some of the breaks you need to avoid. Look at where the break started. You ideally want a break that starts close to the level. That's why we're looking for pre-breakout squeeze. But look at this example here. Break started around here. The movement that led to the break started way below the level. Look at where the level is. Look at where the movement started. Avoid this. Avoid. Yeah. Another trick actually, when you get a fake out, usually in most fake outs, you'll see price actually retest to the level. What do I mean? Yeah. Let me just grab this tool here. What do you see? Price closed above the level, immediately close back below. If you see the immediate close back below, look for price to retrace back to the level. Just this is an exercise. Just go to your chart and look at most fakeouts and look at what price usually does. Price, especially when the breakout starts way below the level, like this one, price will ideally go. Look at the order flow that led to the breakout, then immediately close back below. By immediately, I mean that price not respect this area's new support, just close back below. Usually look for retracement to that level and short it. May work 60% of the time, but if you have a system that works 60% of the time and it gives you 2R or 3R, you're good to go. It doesn't have to work 100% of the time, but this is an exercise you can actually study, especially for the high time frame charts. Your 4 hour in the daily, you just look at it and you can drop your comments. Tell me what you actually discovered here. And the reason why they usually fail, it requires a substantial amount of order flow and orders to actually push price above this level. By the time price gets to this level, it's exhausted. Look at this price action. It leaves what you ideally call liquidity gaps, but that's not a discussion for today. For today, I just want to take you through the anatomy of a breakout. Without traders, as you've seen, by combining these techniques, recognizing the ranges, spotting the pre-breakout tension, analyzing rejection sizes, and using tools like the EMA, you can position yourself for more successful breakout trades. Don't forget to align your trades with the dominant trend to maximize your edge. If you found this helpful, hit the like button, subscribe for more trading insights, and let me know in the comments your biggest struggle with the breakouts. See you in the next video.